What's going on, goats? My name is Raymo, and welcome back to BooKoo Bucks. Today will be day 7 of the ICT Speedrun. If you guys don't know what this is me breaking down 275 hours worth of ICT content down into 31 days and 31 videos. Today, being day 7, we'll be going over immediate rebalance and order flow, advanced gap theory, and ICT core content month 5, part 1. Also, shout out to Lumi Traders for helping me create this roadmap, which is what I'm going to be using for this entire journey. So without further ado, let's go ahead and break down day 7 notes. Day 7, immediate rebalance and institutional order flow. A bearish fair value gap is also known as a SIBI, sell side imbalance, buy side inefficiency. A bullish fair value gap is also known as a busy, buy side imbalance, sell side inefficiency. First time he uses inverse fair value gap, but no explanation. It is crucial to understand your narrative when trading. When using or saying previous day high, it does not always mean the literal high of yesterday. We are always referring to the essence of inefficiency and redelivery. Sometimes price will come back down into a fair value gap, but not fully fill it before moving away. That will be considered a breakaway gap, which he will explain more later. If the narrative is bullish price action and price does not even give the possibility for an inefficiency to exist, this is one of the most powerful signatures for immediate dynamic price delivery. So the key takeaways here, in my opinion, are going to be the reference to the SIBI and busy, because he does use this abbreviation or acronym quite a bit. And also, it is crucial to understand your narrative when trading. It's very crucial because if you're just simply plotting up any form of liquidity, any form of breaker block, any form of order block, any form of basically anything, and you're just trying to trade that simply because you see that on the charts, if you don't have any type of narrative, any type of higher time frame direction that makes everything make sense, then you're probably going to find yourself in a losing position more than anything. Also, he goes over the immediate rebalance here. In this image here, he was showing the daily time frame, and essentially he was showing is that when price opened up on this day, price came down and closed this inefficiency in this area by tapping the previous day high. Again, the previous day high doesn't have to mean the literal previous day high, because essentially this would be the previous day high. But if you notice here, 2 days ago, this was this day's high. So either way, once again, it doesn't have to be literally the previous day high. But price comes down, taps into this area, and does not give the chance for price to leave a fair value gap or the possibility for an inefficiency to exist. So when you see that immediate rebalance, as you see here, usually this is going to cause price to be very snappy, and in this case, move bullish very quickly to the upside. Anticipating where price is going to go is the first skill set you should be learning. Set your trading view to New York time so we can identify New York midnight open. We want to buy at or below NY midnight open if our analysis is bullish, and sell at or above if we are bearish. Speaks about how 8:30 news is usually a move to trigger stops before hitting its objective. In this section here, ICT wants us to set our charts to New York time so we can easily identify the midnight open. And essentially, if we are bearish for the day or we have a bearish objective, we usually want to sell at or above the midnight open. So for example here, if price is going bearish, or at least we anticipate price to go bearish, this dotted line is going to be our NY midnight open. Ideally, if we're looking for shorting opportunities, we do not want to short underneath here, we want to short above. And he also speaks about how the 8:30 news is usually a move to trigger stops. So for example here, we see these relative equal highs. What is going to be above it? They're going to be buy stops resting above. Right here at 8:30 a.m., price comes up, triggers the buy stops resting above, and also you notice price is above the midnight NY open as well. So seeing these two things gives us a confluence that price is now ready to go lower, and as you can see here, price pushes on lower shortly after that. If we had a bullish scenario, we would want to buy underneath the midnight open rather than selling above it. Briefly talks about his 2022 model, buy side swept, new low created, and a short at the fair value gap. So essentially here we can see price takes out buy sell liquidity resting above this high, price ends up making a new low, price pulls back into this fair value gap, and this right here is essentially the 2022 model that he's trying to describe here. Consequent encroachment is the midpoint of the gap. Once the liquidity below the relative equal lows or the main objective is hit, we can expect price to react. We see the low swept and a swing high is broken, and price pulls back to the CE, which is the consequent encroachment of the fair value gap for a long opportunity. In this example here, he is showing that once price has hit the overall objective on the higher time frame, we can go down to a lower time frame to try to find a reversal from this area because we anticipate price to react. For example, here we have daily relative equal lows slash sell side liquidity. So if we understand that there's liquidity down here and that this was the ultimate target on the higher time frame, we understand that most likely there's going to be a push on up after price sweeps out these lows. If so, we can see price breaks above an internal or short-term high and then price pulls back into this fair value gap. In this case, he's using the midpoint, which is a CE, for a potential entry to long out of here. Technically, I do believe that since this fair value gap has not fully closed all the way in, this could also be considered a breakaway gap because once again, it isn't fully being filled in. London close is considered 10 a.m. to noon. New York lunch is from 12 p.m. to 1 p.m. And if you are trading during the London close, you can be aiming for the New York stop run. This does apply to both futures and Forex. New York stop run is going to be where the stops are relative to the most energetic run prior to New York lunch. So I know this might be a little difficult to see because the times are small, but basically the London close is from 10 a.m. to noon. 10 a.m. is here and noon ends about right here. New York lunch is from 12 to 1. So we have 12 here and then we have 1 o'clock somewhere here. If you are trading during the London close, which is off of that first window that we just broke down, you could be aiming for the New York stop run, and the New York stop run is going to be where the stops are relative to the most energetic run prior to the New York lunch. So once again, New York lunch 12 to 1, 12 is going to be right here, and 1 is going to be here. So what is the most energetic run prior to that time period? This right here is going to be it because we have a very huge dynamic explosive move to the upside. So the idea is, or what ICT is showing us, is if we are trading during the London close, we can look for the stops underneath the most energetic run, which will be here. And as you can see, price pushes on lower, and ever so slightly with this wick, price does indeed get underneath. When identifying a breaker block, we use the lowest candle body close and not the lowest wick. And I think this is very important because it's very easy to consider this as the breaker block because obviously this wick low is lower than this one. And if we're trying to capitalize or identify the last sell move before price push on higher, this would make sense. But ICT is saying that we need to use the one that closes the lowest, not the wick. It would have to be the candlestick body closure. So obviously this candlestick body being lower than this one, this would be considered the breaker block. I also did highlight this because as you can see, the breaker block is used multiple times and ICT is perfectly fine with that. Price breaks underneath, uses this as the breaker block to push on lower, and then again, price comes back on up, taps into the same breaker block before continuing to push on lower. Keep opening range gaps on your chart for 3 days. You have to change your chart to regular trading hours to see it. So with these images below, he puts on the regular trading hours. You have to go down to the right hand corner and change it just like you see right here. But once you do, you can see that there is a gap in the market. From here, he will do this every single day and he will keep this out for 3 days in the future. You can use these ranges and expect them to be filled in like a regular gap, and you can use the high, low, and CE of the range as support or resistance areas. New day opening gap, also referred to as end dog, uses the closing price at 5 and the opening price at 6. So very similar here, but we're using the closing price at 5 and the opening price at 6. And if there is a difference in the price points, we can go ahead and mark that out and consider that our end dog or new day opening gap. This information may seem like a lot, but you do not need to use all of it. Find what works best for you. 10 to 11 is going to be the silver bullet hour. Here is another 2022 model example. Run on stops, shift in market structure, long at fair value gap. You can combine silver bullet and 2022 model. When using the silver bullet, you are really only looking for a 10 handle or point range. So very important here on this first point, it is a lot of information, but remember, you don't need to use all of it. ICT is just simply telling us everything that he does use from time to time, and maybe he does have days where he uses it more than others, but at the end of the day, You can choose exactly what works best for you, and that's all that matters. I will also break down the silver bullet a tad bit more in the next section, but for now, he just breaks down another 2022 model. Simply put, you can see sell side liquidity is swept underneath these lows, price breaks above this high, price pulls back, taps into a bullish fair value gap, and you can simply long after price fills it and then look for new highs. When using the silver bullet, you want to use a fair value gap that forms in between 10 and 11. It does not need to be a fair value gap that formed between 10 and 11, but the entry will be during that time. A shallow run on sell side liquidity is usually a sign that is going to drive lower. The bullish move is just a retracement. So, simply put, with the silver bullet, you are going to be taking an entry in between 10 and 11. You will be using a fair value gap, but again, that fair value gap doesn't have to form during that time. The entry or the time price hits that fair value gap where you look for an entry will be during that 10-11 window. So, for example, here, this is 10 a.m. and this is 11 a.m. So, during this hour, we're going to be looking for a potential silver bullet entry. Here, we can see this fair value gap forms at about just right before 10:30, and price taps into it before pushing on higher. In this case, the fair value gap is created within this window, and we're using this one to catch our entry within that window. But again, the fair value gap may come from somewhere further left, and we can still use that. But once again, the biggest thing is that our entry is going to be in the form of price filling a fair value gap, and we're going to be taking that entry in between 10 and 11 a.m. A shallow run on sell side liquidity is usually a sign that it is going to drive lower. The bullish move is just a retracement. And I thought this was interesting because, as you can see, price creates these equal lows and price technically gets underneath it. At this point, it's hard to determine if this is the sell side liquidity sweep to then push on higher, or is this simply just another equal low, or if you want to be technical, a relative equal low. Essentially, here he is showing that if price breaks underneath it or gives a shallow run on sell side liquidity, usually this really isn't the true breakout. This is just simply building up more sell side liquidity for the banks to run it at a later time. Give a slightly different definition of a mitigation block here. The mitigation block is the down close candle in between the high and lower high. You do not need the seconds time frame to trade, but you can if you would like it. So I want to point out here in the previous section going over mitigation blocks, he actually marks up this entire buy move before price dropped lower, this entire buy move before price fell to make a new higher high. And then from here, we can draw this entire area as the mitigation block. But in this case, he kind of treats it like a breaker block. He just marks up the last down move, this last down candle before price push on higher, and then extended it out to the right. So I just wanted to point this out. Technically, he does have two different definitions or two different ways he has broken it down. So keep that in mind. He also goes to break down the charts to the seconds time frame. It is very possible to trade the seconds, but again, don't feel like you have to. It is just something that you can use if you want to. When looking left, we can see the higher time frame void / lower time frame fair value gaps as price pushes higher. We anticipate price to fill these areas. As price begins to fill them, price becomes efficient and we don't expect price to fall beneath. In the example below, once price breaks above the high, there is no reason for price to go back below it. Look for bullish price action to fill the other fair value gaps above. So once again, I do apologize for this image being quite small, but obviously I had to fit it in somehow, some way. But either way, let's go ahead and break this down more in detail to hopefully give some better clarifications to what ICT is trying to show us here. So as we can see, we have objectives to the upside, but at the same time, does price have a reason to go lower before going higher? And ICT's answer is no, because all the price action underneath is efficient price action, meaning price has no reason to come back down. Everything is efficient and balanced. So right here where ICT has its cursor, once price breaks above this high, there is no reason for price to drop lower because everything in this range is balanced. As price continues to make new highs, there is no reason for price to come on lower because everything is balanced. As price is pushing on higher, remember the objective is to fill the void or these fair value gaps. And there's a reason why price decided to fall from here. Well, the reason why it did is because at this point, price already filled the void and filled even this very small, minute fair value gap down to the tick. So once that's all filled and all the objectives are completed, then at that point, price could potentially fall on lower. But before price came up to that point, we had no reason to anticipate price to go lower for all the reasons that I just gave. There is a 2 to 3 p.m. silver bullet window. When the close price and the open price do not match, this is a real liquidity void because there are no traders or trades in this area, no sellers or buyers. So the same way we look at the 10 to 11 a.m. silver bullet window is the exact same thing we can use for the 2 to 3 p.m. window as well. And this one here, essentially, when you see a literal gap in the market, this is going to be a real liquidity void because there are no buyers or sellers. Usually, when you have that void in the market or a fair value gap, you have the busy or the SIBI, where you have one side being buyers or one side being sellers. But in this case, there is a real liquidity void here because there are literally no trades or traders right here at this specific level. The second fair value gap is not a good setup because it is too close in proximity relative to the low it just took out and the high. Price can easily run up higher to take out buy sell liquidity above it, just like in the image. When you see price aggressively move up and down as it did here, you really do not expect the fair value gap to completely fill. We can view it like a breakaway gap. So this first point here, he is showing how price does create a fair value gap here, but he does not consider this a valid setup or a good setup to go short because there is this high relatively close to this area. Again, this is all relative. There is no um, rule based way to determine if it is too close to the high or not. But as you can see, this fair value gap is relatively close here. So it's very easy for price to run the fair value gap and take out buy sell liquidity before pushing on lower. And also, when you see price aggressively move up and down as it did here, meaning right here, we can see price aggressively moved higher and then move on lower, we can essentially anticipate price to give us a breakaway gap, which obviously we don't anticipate price to fully fill. Again, there's no rule based system to really identify or confirm if it is a breakaway gap. It is simply if price hits the higher time frame reference point, POI, whatever you want to call it, and then price moves aggressively in this manner, usually price is going to leave this area as a breakaway gap. Generally speaking, but not always, Thursdays can give you the opposite end of range. If price has been bullish all week, we can create the high of the week on Thursday. One thing I do want to add, which I did forget to add in the notes, is that we can use the high, low, and C of the range as support and resistance. If you guys do go back and watch the video, for example, this low right here of the Tuesday/Wednesday opening gap range, ICT would potentially look at the low of this range as a area of support or some type of confluence to go long off this area. Same thing up here, price bouncing off the high could act as some form of resistance or some form of confluence to go short off this area. The CE is simply the midway point. We can see how this wick down here taps at the 50% of this entire range, and potentially he could use that as confluence to go long. Advanced gap theory introduction. Premium wick consequent encroachment is making up the 50% of a wick. Balanced price ranges tend to either stop at their high or low or midpoint. This is not to be confused with supply and demand. These cut through candles. Price is most likely not going to break this area. So this first point here, I did forget to add an image here, but I do break some more down in the coming up slides. But essentially, if you have a wick and you mark the 50% of the wick, that is a premium wick CE. For the second point, we have a balanced price range tend to either stop at their high or low or midpoint. So essentially, we can see that there is a sell side imbalance, buy side inefficiency, giving us a bearish fair value gap. Price comes up and fills it, but instead of price continuing to push on higher and then leaving some other form of a bullish fair value gap, we can see how the wicks trade up and down, leaving no form of inefficiency. So I believe here this is why he's calling this a balanced price range. And even though price does break through or I should say, the zone he's using, which is the fair value gap, is cutting through the candles. This is perfectly fine. And that's why he says it's not to be confused with supply and demand because these cut directly through the candles. But essentially, when you have a balanced price range, he says that price should basically always respect it and not break through it. Ideally, we want to take low resistance liquidity runs. Those scenarios usually create quick moves to our anticipated targets, unlike high resistance. When consolidation is met with consolidation, it is not a clear sign of where price is headed next. When we see price spending time in a range, which is the first circle, this is going to be considered high resistance liquidity. It is going to take a real significant price move to get below. So with this image here, we can see how price moves in a range before pushing on higher. As price pushes back down to this range, we have another range. When we see the range, meaning a range, there is really no clear sign of where price wants to go, but we do know that usually this low down here is going to be high resistance liquidity. It isn't going to have a easy time of running the low. So most likely we will see price move higher, but we need to see some more details to really confirm if price is going to go higher or potentially take on more sell side liquidity before moving higher. ICT is still using the daily fair value gap shown in the previous image. Price has broken through it, but he is still using it to watch how price reacts around the CE. We wanted to see price stay below it to confirm price wanted to continue to go bearish. Since he's seen price get above and even get up to the high of the fair value gap, this gave him the sign that price would go higher and not attack the sell side liquidity. The sell is a possibility to go short, but ultimately it is a trap. So this orange zone is the exact fair value gap that we see on this image. And ultimately, we want to see if the analysis is right and price is going to go higher. We want to see price break underneath it and stay below it. That's why even though price is breaking through it, one, on the daily time frame, we never actually get a closure underneath it, which I know is very important for him. But even as price on the lower time frame is getting underneath, we want to see if price is going to maintain or stay underneath or break higher. And essentially here he has the CE, which is the 50% of the fair value gap. And once price broke above here, this was his sign that price was indeed going to move higher rather than go lower. So once price got above here, ICT has shown us that he did not anticipate price to actually take out the sell side liquidity underneath. Simply seeing that price was staying above the CE and even tapping the high of the fair value gap and not staying underneath it, price was more so bullish and again not anticipating the sell side liquidity underneath to be swept. And if this is the case, any shorting opportunity is still a valid setup because as you can see here, this is probably quite a bit of a move to catch. But ultimately, we want to see longs to the upside because obviously that is going to be the overall bigger move we are anticipating. Gives another example of the CE of a wick. This one cuts through a candle. Smooth edges like to be made jagged. Equal highs and lows tend to get ran. So like I said, I would bring up another example of the CE. In the first image, the CE of this wick right here would simply just be the 50% or the midpoint of this wick right here. But he also does show that we can use wicks that are cutting through candles just like this. Or I shouldn't say the wick cuts through candles, but basically we are marking up the midway point that does cut through candles. And smooth edges like to be made jagged. Simply put, when we see equal highs, this is a good sign that price will want to run them, or when we have equal lows, price is most likely going to want to run those as well. He will continue to use NWOG or new week opening gap lines even if price cuts through them. They can still be used as confluences for entries. So again, very hard to see, but that very top line is the current NWOG high, and then we have the current NWOG low. So he will actually draw this out even though price already fills it and breaks above and below. We can see how price comes in and taps this area before pushing on lower. So once again, even if price does fill those areas and come back into those areas, he will still drag it out later because it potentially could be used as a form of confluence to take an entry off of it. Gives another example of the 2022 model: buy sell liquidity swept, shift in market structure, and enter off of a fair value gap. If you missed that, you could have used the NYAM silver bullet: shift in market structure, fair value gap created, and entry of the fair value gap during the 10 to 11 window. With this image here, we have a buy sell liquidity sweep. Price breaks a low, price pulls back, fills this fair value gap before pushing on lower. If you did miss that, then we have the silver bullet strategy. During this move down here, price created a fair value gap, price pulls back in, taps into that fair value gap within the 10 to 11 a.m. window, and that could be the shorting opportunity to catch the move on lower. We can use swing points for potential projections. Use those points with the fib to mark up one standard deviation. So with this image, he didn't really explain why he's using this low to this high and not any other low to the high. Ultimately, he's just marking up the overall swing move. And essentially, if you draw the fib from the low to the high and mark up one standard deviation, we can see down here, price comes down to that level. So essentially, the one standard deviation is a potential take profit that we could potentially use. We are going to break down each gap of this entire move. The first one is a common gap or a fair value gap. Stops can be placed above the candle's high of the one that formed the fair value gap. You can place it above the swing high for a more conservative stop. So here we have that same 2022 model, price creates a fair value gap. When we take a short at the fair value gap, our stop loss can be placed above the candle's high of the one that formed the fair value gap, meaning this one right here. Our stop loss simply can be placed above here. If we do want a more conservative stop, we can place it above the entire swing high point right there. This one is a breakaway gap because it is breaking away from the important higher time frame objective from what we already anticipate price to fall from. If it truly is, price should not break above, so you can place your stop above the candle high. So here he doesn't really explain exactly a rule-based system to identify a breakaway gap, but essentially if price hits your overall target and you anticipate price to move away from it, and it does so aggressively, such as here, essentially this can be considered a breakaway gap. And if you are taking a trade from this breakaway gap, putting a stop loss above this candlestick high should be good enough. Placing above here would be kind of pointless because again, if it truly is a breakaway gap, price wouldn't even get close to here. Standard fair value gap on the 2-minute time frame, they can be traded back into multiple times. So with this one, this is basically the exact same thing as the first one, but the biggest difference is that this first one is a standard fair value gap because it's a 3 candlestick pattern. Usually in this case, he probably would consider this a liquidity void of some sort, but essentially since this takes up 2 candles, if we go to a higher time frame, those 2 candlesticks will be one, and essentially it would look like a normal 3 candlestick pattern. So it's just a different perspective of it, and depending how you want to word it, it's basically just about the same exact thing. This one specifically is a measuring gap because we can use it for future projections. Uses the end of the fair value gap instead of the beginning like the other section. So I did want to point this out because we have gone over the measuring gaps, but it was kind of confusing because in the previous section we used a different tactic or a different way of using the measuring gap. In the other section, you'll notice that he uses a swing high and drags it all the way down to the wick low of where the measuring gap began. In this case, he's drawn it down to the wick where the measuring gap ended. So once again, it is a different way of doing it. I'm not too sure if it's kind of a pick or choose, or it does depend depending on the situation. He did not elaborate, but I did want to point out that there is a little bit of confusion on exactly when to or how to use it essentially. But here he teaches from swing high down to the bottom of the measuring gap, and then from there we can use one standard deviation to figure out how far price may potentially go. So high down to this low, one standard deviation is down here, and we can see price comes down to it right there. Watch how price candles close. The candles bodies are respecting the low. The bodies tell you the story, the wicks do the damage. So this kind of ties back into the other fair value gap because price can create a fair value gap and tap it multiple times. That is perfectly fine based on ICT's or in ICT's eyes. So here we have the fair value gap, price taps it, respects it, taps it, respects it. And then specifically here, he's teaching us or trying to tell us, watch how price closes relative to this area, meaning relative to the low or the bottom of the fair value gap. The wicks do the damage, but the bodies tell you the story. So in this case, if you see price closing right at that low, this could be a confluence to take shorts off of that fair value gap. Month 5, quarterly shifts and IPDA data ranges. Believes the markets are 100% engineered and controlled to the very pip/tick. IPDA has data ranges that it works within, and by understanding what those ranges are, we can go into the marketplace with a predetermined idea where the algorithm will do its work. Where is it pulling the information from? What dates, what ranges, and what specific highs and lows is the algorithm reaching to as a reference point. The quarterly market shift, IPDA data ranges, 3 to 4 month major market shifts. This has to happen because the market has to generate new interest for traders. Smart money accumulation for buy programs. A buy program is when the market goes through a series of successive days or sessions that are consecutive regardless of what time frame it is, but for this lesson we focus on the daily. Manipulation and underline versus benchmark. Underline is what you are actually trading, and the benchmark is what you are measuring the potential manipulation or lack thereof. Benchmark makes lower low, underline makes higher low. Expect a measure of upside movement only for correlated markets such as DXY and USD JPY. Underline makes lower low, benchmark makes lower high. Expect a measure of upside movement only for inversely correlated markets such as DXY and GBP USD. Benchmark makes higher high, underline makes higher low. Expect a measure of upside movement only for inversely correlated markets such as DXY and GBP USD. So let's try to break this down step by step. The benchmark makes a lower low, underline makes a higher low. And again, this only works for correlated markets such as DXY and USD JPY, or basically anything that has USD in the front. So the underline is what we are actually trading, which will be USD JPY, and the benchmark will be DXY. If the underline makes a higher low and the benchmark makes a lower low, essentially we should anticipate a measure of upside movement, because if USD JPY is making a higher low, that is showing that price wants to continue to go bullish. If the benchmark makes a lower low, it is sweeping the sell side liquidity underneath that low. If price is taking out sell side liquidity underneath that low, we should see some form of reaction to the upside. So if DXY is going to continue to gain strength and push on higher, USD JPY should also continue to push on higher as well. Now for the second one, we'll be dealing with inversely correlated markets such as DXY and GU. If the underline makes a lower low, meaning if GU makes a lower low, and the benchmark makes a lower high, meaning the DXY is making a lower high, DXY is failing to make a higher high, meaning DXY is losing strength. And if GU is making a lower low, taking out the sell side liquidity from the previous low, most likely since DXY is pushing on lower as well, that'll cause GU to push on higher. And again, seeing that price is taking out liquidity from the previous low, we should see some form of reaction. So again, anticipating a form of reaction after taking out sell side liquidity on GU, and then seeing DXY showing us signs that it wants to continue to drop on lower, we should basically anticipate GU to push on higher. And for the last one, it's going to be the exact same markets, but instead the benchmark, which is DXY, makes a higher high, and then GU makes a higher low. If GU makes a higher low, it looks like it wants to continue to push on higher. And seeing DXY makes a higher high, if it makes a higher high, it has to take out the buy side liquidity from the previous high. We should see some form of reaction after price takes out that buy side liquidity. If the reaction does occur, DXY should push on lower. If DXY does push on lower, that should cause GU to move on higher. So therefore, we expect a measure of upside movement. Money accumulation for sell programs. A sell program is when the market goes through a series of successive days or sessions that are consecutive regardless of what time frame it is. But for this lesson, we focus on the daily. Manipulation and underline versus benchmark. Underline is what you are actually trading, and the benchmark is what you are measuring the potential manipulation or lack thereof. Benchmark makes a higher high, underline makes lower high. Expect a measure of downside movement only for correlated markets such as DXY and USD JPY. Underline makes higher high, benchmark makes higher low. Expect a measure of downside movement only for inversely correlated markets such as DXY and GU. Benchmark makes lower low, underline makes lower high. Expect a measure of downside movement only for inversely correlated markets such as DXY and GU. So basically, it's the exact same thing we went over, but inversed. And I won't sit here and break down everything I just went over for time's sake purposes, but ICT did reword it in another way for you guys to potentially understand it a tad bit better. You can divide your chart up into every 3 or 4 months to help find shifts in the markets. The images below are on the monthly charts using January to January. So these red lines represent January to January, January to January. The biggest difference is that this is split up into 4 different sections, and this is split up into three. Either one can be used. Quarterly shift, the look back, 60, 40, 20 trading days. You want to start off by using the first trading day of the past month, but for simplicity reasons, you can just start from January 1st. Find that day and then look back 60, 40, 20 trading days. The algorithm will reach back about 3 trading months worth of data. Identify institutional order flow, refer to recent institutional reference points, old price high and low. Look for liquidity pools slash rejection blocks, bullish, bearish order blocks, fair value gaps, or voids. Anchor vertical line to previous market shift. Look for the high and the low. If the market has been trading higher, you will frame everything off of the market low. If the market has been trading lower, you will frame everything off of the market high. So with the image below, we're going to mark up January 1st. And then once we have this line, we're going to do the look back, which is identifying the last 20, 40, and 60 trading days worth of data. When we do this, we want to refer to recent institutional reference points, which will be all of these points. So for example, we can mark up the low, we can mark up the high, we can mark up sell side liquidity areas, and maybe even this market structure shift after price broke underneath. We want to look at where the market has traded from, what was the institutional order flow at that point, and at this time, we can see clearly between the October and November into December, the market had been trading bullishly. We're anticipating a move back into institutional reference points, then making or moving lower, looking for that same event to occur, looking for lower levels of institutional reference points. We can look back at the 60-day range and look to see what it created and or left. In this case, sell side liquidity is under the short-term lows. So this right here is actually a better image as we are more zoomed in, but essentially we're marking up the reference points that we could potentially use in the future. Cast forward. When you look ahead with the same parameters we use when we look back. We anticipate the next market shift in the next 20 to 60 trading days. Cast forward 20 days when last shift was 40 days ago, always using a reference point of 60 days. Cast forward 40 days when the last shift was 20 days ago, projected 3-month limit. The algorithm is going to anticipate doing a shift in the marketplace in that range of 20 to 60 days. Helps identify higher time frame shift setups. So what I think he's showing here is price gave a nice bearish move here, giving us that market structure shift that caused price to push on lower. Now from this point, we always look at a 60-day trading window. So in this case, since price moved lower here or that market structure shift happened here, we would project price out 60 days for a potential shift in the marketplace. If price gave a market structure shift 20 days prior to this line, then probably we'd be looking at the 40-day mark. But essentially, going out 60 days from the most recent shift in market structure, we could then identify potentially a shift in the marketplace during this specific trading day. Not the specific trading day, but during that specific time near that 60-day trading day. And in this case, he is plotting up the fair value gap because this would be an institutional reference point, just like we marked up the low and the high and the sell side liquidity areas. A fair value gap would be another form of that. Show the chart of Euro USD using these same concepts. There's a shift right at the 60-day mark. So same thing here. We have a shift in the marketplace as price push on higher. Since it happened right here at the very beginning, we could look about 60 days after, and then we have another shift on lower. And obviously, if we go back, if this is DXY and we anticipate price to push on up at this 60-day mark, then obviously a pair or a market like EU should do the inverse, which would be drop on lower from this point. If the markets are not random but manipulated and controlled, there should be characteristics that repeat themselves and it should be measurable, and we should be able to see things repeat based on criteria. The algorithm will seek to do something in the first 20 days to first 40 days and up to 60 days after the most recent market structure shift. Looking back at DXY, we can see higher highs being formed during the 60 days, also filling the liquidity void. So even if we take away all the things we went over on why we anticipate price to go lower based off the quarterly shift, we can simply see price is making higher highs relative to the daily time frame. Now, if we look back at Euro USD, EU is the underline and DXY is the benchmark. The underline is failing to make a lower low at the same time the benchmark is creating higher highs. By all standards, DXY looks bullish as it is creating higher highs, but we understand it is a retracement to fill the void. The higher highs on DXY are not being seen with lower lows on EU, and it is occurring in between the anticipated quarterly shift. So once again, kind of ignoring that, yes, we understand the higher time frame and the quarterly shifts, we anticipate price to go bearish, but simply seeing price is making higher highs on DXY. But when we look at EU, price is actually making higher lows. Usually, if we see DXY pushing higher and making higher highs, usually EU should be making lower lows. But this is what ICT is trying to wrap together on the very first thing we just broke down on this specific section, which is basically going to be here, which is the smart money accumulation for buy programs. So when we add all these things together, we understand that DXY is most likely going to fall lower and EU is going to continue to push on higher. In the next example, we can see DXY on the daily gives a market structure shift and price is making lower lows. So here we have price break above and then push on lower. As price push on lower, we can see these lower lows being created. Going to EU around the same time, we are not seeing a higher high. You would think we would be, but we are not. Don't get caught up with the red line as we need to look at every institutional reference point. So once again, usually when DXY is making lower lows, EU should be making higher highs. Here we can see price makes a high, but does not make a higher high. Instead, it makes a lower low, which is usually what we're not used to seeing, or at least it's not what we're anticipating to see. Which ties us back to here, which is going to be the smart money distribution. Sorry for the accumulation there, but the smart money accumulation for sell programs. So when we see this, we anticipate DXY to continue to push it higher and then EU to fall on lower. Here we can see price makes a higher high, but we need to understand or look at every institutional reference point, which will be the points on the higher time frame. I think another easier way to look at it, for example, if we are simply marking up these highs here, that means we should simply be marking up these lows here. But instead, we're marking up all of these lows from this date out. So we should also look at the highs from this date out as well. He then talks about how we can go back and study these specific wicks in the market and how they line up with the 20, 40, 60 days. So again, using those points, go out 20 days, we can see price actually gives a quick spike to the upside, taking on buy side liquidity and pushing on lower right at about that 20-day mark. Again, here, price takes out buy side liquidity right about at that 60-day mark before continuing to push on lower. So again, the 20, 40, 60 days will be very crucial to the higher time frame shifts in the market. You can also see how price is creating a higher high relative to the second circle, but DXY is not creating a lower low. This tells us EU is taking out buy stops to go short. So this is just another example we went over. We can see EU is making a higher high. Usually if that's the case, DXY will be making a lower low. But in this case, DXY does not make a lower low. DXY actually makes a higher low. And this tells us EU was taking out buy stops to go short rather than price continuing to push on higher. So that is it for day 7 notes. If you guys do want these notes for absolutely free, click the link in the bio, join the free WAP, and they'll be available to you in there. If you guys have any comments, questions, or concerns, please drop them down below. Thank you for watching, and I will catch you in the next one.